Hey, what's up, everybody? Welcome to Super Stonk Bros number 15. We have myself, Macro 108, our increasingly regular guest host, Matthew Kanterman from Bloomberg Research, based in Hong Kong. I can see your background there. Looks beautiful.
Yeah, it does.
Awesome background there, Matthew. And co-host Steve Pally, although I should say Dr. Pally, PhD in political science. And I believe your background, Steve, should serve us today. Is that right? What are we talking about today, Steve?
Well, I'm going to give it the old college try. I'm a bit rusty when it comes to international relations, but I spent a number of years thinking about it in some detail and actually used to have my own podcast about it too. So yeah, we are going to be talking about a pretty serious situation, or at least if you're investing in China, it's a pretty serious situation. Basically, the Chinese government has acted against the Uber of China, which is a company called DIDI. And forgive me if I butcher any Chinese pronunciation during this show. So DIDI is very, very successful within China, hundreds of millions of users in China, and basically applied for a listing on the New York Stock Exchange, successfully listed, I think the week before last, and floated $3 to $4 billion. I'm not exactly sure what the actual figure is. $4 billion. Thank you. Stock went up, looking good. Beijing comes back and says, "Hey, wait a second, guys. You did this improperly. We have a cybersecurity issue." Right? The Ministry of Cybersecurity, or whatever it's called, I forget exactly what, is basically saying we have some data privacy concerns. So we're going to have to go ahead and pull your apps off of all the app stores in China, which of course tanks the stock to the tune of between 30 and 40%. It's recovered a little bit towards the end of last week, but this was like virtually overnight. And this was a big deal listing, right, on the New York Stock Exchange. So, this comes after Chinese regulatory authorities have also interfered and messed with another of China's, I guess, homegrown internet giants, Alibaba, which, Joe, I know you've invested in.
Yeah.
You talked me into investing in Baba as well. So it seemed like a good idea.
Heavy.
Yeah.
Those bags are heavy.
Right. We have concerns. And I think we need to get into this for any investor that has invested in the stock market and has picked up any of these NYSE listed firms that are big in China and producing outsized returns, have done very well in the context of China and for US investors, depending on when you bought it, of course. But it seems like the political risks are growing in a pretty serious, perhaps exponential fashion. And one could argue, well, maybe they're priced in, so now is a great time to buy. One could also argue, sell right away, because what we're seeing here is obviously not market-motivated behavior in any way. This looks like a power play on the part of the Chinese Communist Party, which appears less and less interested in the private sector, in property rights, in allowing innovation, and allowing, in particular, homegrown competitors to your Amazons, your Facebooks, your PayPals, and so on. And you could debate the merits of that decision, but as a investor sitting here in the United States with a certain amount of money locked up in Alibaba, I am asking myself the question, should I sell it all tomorrow before things get worse? Or should I actually be buying? Because perhaps this is a risk premium opportunity. So that's what we're going to talk about today on the show. Before we do, though, I think we should perhaps get into the subject of how these gigantic Chinese companies are listed on the New York Stock Exchange, because they're not listed kind of along the typical way of doing things. Right, Matthew? They use something called a VIE, variable interest entity. Is that right?
Yeah, so let's talk about what you're actually owning when you invest in a Chinese company that's listed anywhere outside of mainland China. And that
Right.
includes Hong Kong. Even the Hong Kong listed companies have to do this. So it's illegal for foreign investors to own protected businesses in China. That is a law that has existed for a long time. In the 90s, it was telecom carriers. In the 2000s, and since then, it's been, the internet and tech sectors have been protected largely. And yet we've seen all these companies list abroad. How do they do it? So it actually started in the 90s. China Unicom was the first to do it. And then in 2000, Sino was the first to do it. That's like the search engine. They were the first to do it with this VIE structure, but China Unicom did it in a slightly different structure before that. What you do is you set up a company in a tax haven like the Cayman Islands, the Virgin Islands, even Hong Kong, whatever. And you sell shares in that company. And that company enters legal contracts with the mainland entity, Sina, Alibaba, whomever, and provides consulting services or something, management services for their operations. And through the way these contracts are structured, and even Tencent calls them structured contracts, they don't call them VIEs, through the way that these contracts are structured, that offshore entity gets de facto control of the business without actually owning any part of it. They get the economic interest and therefore de facto control, enabling them to, on an accounting basis, completely consolidate those operations. And there you go, with the proof of accounting, you own the onshore business without actually investing in it. And this is how every single offshore Chinese company has to be structured legally to facilitate your investment. So this has been a risk that has been known. I don't know if it's known necessarily by the retail crowd, but it's definitely been known by institutional investors since this started. I mean, this was always a risk that was called out. Carson Block is a famous short seller. He's been calling this out for over a decade now. It hasn't resulted in any negative impact, but it's always a risk, and it's completely disclosed in all of the filings of these companies. But it's becoming more of a risk now than it was just a couple of weeks ago, as China starts to more closely scrutinize these structures. And I know we're going to dive into what's happened recently, but this is just kind of setting the stage for what these companies actually are and what you actually own if you buy these shares.
Got it. So it's kind of a loophole that has been left open and not enforced for some period of time, is what you're saying?
It lives in a legal gray area. So the Chinese government hasn't officially endorsed it, but they also haven't cracked down on it. And they could they could go nuclear on it, and they say, no, these are illegal, and poof, all of the shares are worthless in an instant. I think that onshore, they recognize that a lot of these companies wouldn't be where they are today without foreign investment. And so the money that has gotten in through these structures has been beneficial to the Chinese economy overall and to the development of the tech sector, particularly. And so, there's a lot of understanding that they don't want to blow it up because they recognize the value in it, but they also don't want it being abused. They don't want it creating risks, national security risks, data privacy risks, whatever, domestically. And so that's where the increased scrutiny now is coming from.
Right. This almost reminds me of like Bitcoin, right? How China had outlawed Bitcoin and people kind of understood that, they knew that, but then all of a sudden, then they just shut down all the mining operations just like that. And similarly, in this case, this investment into these Chinese entities, to your point, Steve, and the way that you explained it, Matthew, exists because of a legal gray area. And so it seems like to understand really what this risk is, we have to kind of understand what is the objective of the Chinese government, right? And I can kind of understand in the Alibaba case, Jack Ma was openly criticizing the government, crackdown, right? In the DIDI case, you could tell where these guys are going. You can tell where government officials are going. You can kind of create a map, and you can kind of see what's happening with the government itself. So yeah, I can kind of see why they may potentially crack down on that until they're absolutely sure those issues are taken care of. But what do you guys think in terms of the objective of the Chinese government? Do you think that based upon what they want, that there is a risk for some of us investors, whether we're investing in Alibaba or Pinduoduo or other Chinese companies, whether there is risk for this nuclear case where everything just goes to zero?
I mean, I would say before it was basically zero. It's now maybe slightly more than zero, but it's still extremely low. So I don't think they're going to go nuclear on the existing companies. I think that this is going to create a higher degree of scrutiny for future listings. And you've already seen a few Chinese companies that were planning to IPO pull their IPOs that are using this structure because they're being more closely investigated. So I don't think they're going to go nuclear on the existing listings. I think they're going to be more closely regulated and scrutinized going forwards. And it'll still be used, but there'll be definitely a slower cadence of IPOs from Chinese companies abroad going forwards.
Yeah, and I have to imagine that those IPOs will not be successful going forward either. Which is not to say that like the Chinese companies won't want to do it, right? Because we have the most sophisticated capital markets in the world. This is where you want to raise. It makes sense. You get a lot of money really fast, sophisticated investors, a lot of know-how. All of that is very helpful.
And Hong Kong is making it easier to IPO for these companies as well.
Okay.
We've seen a lot of them do what they call secondary primary listings in Hong Kong, like Alibaba, NetEase, JD.com have all done this recently, and many others.
Right.
When they list in the US, they sell ADRs or ADSs. These are actually not primary shares. These are receipts that you can basically trade in for shares whenever you want. That's how any company lists abroad. But in Hong Kong, they actually list the primary shares. They're allowed to. And so you've seen a lot of them list the primary shares here. And you've even seen a lot of institutional investors exchanging the ADRs, ADSs in the US for the primary shares in Hong Kong. And what Hong Kong is doing is by the end of the year, they're going to reduce the IPO settlement time from 5 days to 2 days. So currently it takes 5 days for the IPOs to settle here, which is a long time. They're going to shrink it to 2 days, and they're evaluating getting it less than 2. In the US, it's overnight, right? So it's basically T+0 in the US for IPO pricing and settlement. So if they can get IPOs to trade, within a shorter period of time, that's going to make it more attractive. They've also relaxed the rules around dual class share offerings. That was restricted in the past in Hong Kong. So not only do I think a lot more of them will be listing in Hong Kong also, not just in the U.S. going forwards.
Then that would seem to be some kind of coordinated action on the part of the Chinese government. The Chinese government has established more control over Hong Kong, as you well know, being in Hong Kong.
And you have the Stock Connect with the mainland. So now you can have both mainland investors investing in Hong Kong and Hong Kong investing in the mainland. So there's free flow of capital. So for a lot of reasons, that makes more sense going forwards. It's just in the past when you had the restrictions on dual class shares, especially, and you had the longer settlement period, plus you had the bigger base of capital, as you mentioned in the US, it made sense to list in the US. But increasingly, the advantages of listing in the US are going down. You have some crackdown from the government around the ability to audit these companies. So there's a lot of factors that are pointing to this shifting more and more to Hong Kong and less to the US anyways.
Got it. So they're kind of spinning up their own version of what they would want to do on the New York Stock Exchange anyway. The question is, like, how quickly can they establish that? Will they ever be able to establish parity, right? Given the characteristics of how the Chinese regime works, and there are other questions besides. I mean, to answer the question, to get back to what Joe was asking, is there a risk that they would just pull the plug overnight and do like a hard decouple? I think that, as you say, Matthew, is a limited risk, but it's non-zero at this point, especially if certain geopolitical events kick off. And the main one I'm thinking of is, of course, like a shooting war, right, over Taiwan. And frankly, that's a non-zero chance of that happening too. Barring that, though, I cannot imagine a circumstance where the shares would just for Alibaba, for Pinduoduo, for JD.com, and all these other companies would just vanish from the New York Stock Exchange overnight. I don't even know what would happen to the value of those shares if they get delisted. Like, that's one question I had. Like, do you just lose your money when that happens? Are you done? I see you nodding, Matthew. Like,
pretty much. I mean, it's kind of uncharted waters, but yes, I mean, probably. Like,
got it.
Yeah.
Because you no longer have any, like, the legal claim to the third party entity would be dissolved, and the third party entity would be rendered meaningless anyway, right? In the Cayman Islands or whatever, the
The
VIE.
economic
So,
interest in the underlying business on the mainland would no longer exist. Yeah.
got it. Yeah, because like that's only allowed to happen by, I guess, the assent of the Chinese government in the first place, even though it's passive at the moment. So if they were to revoke that sort of implicit imprimatur, then yeah, this could unwind very quickly, but they wouldn't want to do that. I don't think.
Yeah, I mean, I think if you take it back to what is the objectives of the Chinese government, I mean, it seems from my perspective, I'm not so worried because it kind of makes sense to me, right? It makes sense
Mm,
from the perspective of one, criticism of the government. You criticize the government, you don't do that in China.
not
You know,
anymore.
two, sensitive information. Like you, I mean, obviously, if you've got data on the whereabouts and the travel in between government officials' buildings and things of that nature, that's not cool, right? And so that makes sense to me. Yeah, they don't want that information getting out. And third is market protectionism, right? And this in the gaming industry, we've seen that you can't launch games or mobile apps in China without a local partner. You have to get specific licenses. You have to have restrictions around, and the Chinese government actually there's a bunch of restrictions there that protects their market in favor of local entities. And that, I mean,
Mm-hmm.
and so, we've seen each of those three impact different companies, right? So the criticism was Alibaba, the sensitive data was DIDI, and the market protectionism, potentially, we've seen that affect all sorts of gaming companies. It could also potentially impact Tesla, something I'm a little bit worried about.
Mm-hmm.
But I mean, from that perspective, though, to me, it makes sense. And barring war, to your point, Steve,
Yeah.
I would say we're relatively safe. I think.
Yeah. I mean, we're safe from like going to zero overnight right now. I don't know that we're
Yeah.
safe from having our value busted down further, right?
Yeah, I mean, I
On the way
guess,
to zero.
yeah, the way I would think about it though is like if there was a objective that made sense from the Chinese government, like market protectionism is one that could impact Tesla, for example.
Yeah.
But I mean, then that makes sense, and that's a Tesla risk that you could factor in. But aside from that, I would say for me the VIE risk is relatively low for me, and
Yeah.
and which I think is what you're saying as well, Matthew. Right?
Yeah,
But to you, it's just non-zero, which I agree.
exactly. And you guys mentioned Alibaba, and you look at Tencent, it's down 30% from its January high.
Right.
Yikes.
These, and Tencent hasn't even been fined yet. We don't know if they will be, but everyone
Right.
expects Tencent to at some point get something similar to what happened to Alibaba. Um, Clearly people are pricing in not only the impact of some sort of penalty, but with all of the new regulations coming online in China around data privacy, data sovereignty, the ability to do analytics, weaponizing and monopolizing data within industries, and kind of preventing that, making the government the monopoly on data, not these companies, right? In games, Facebook is kind of a huge data powerhouse in terms of user data, right? And, they don't want DiDi being that in the ride sharing space. They don't want Tencent being that in the game space. They want the government to be that. And so strategically from that perspective, what that does to the structural growth of these businesses long term, given their business is so highly dependent on data analytics, is just a huge question mark that nobody can answer. And I think that's the biggest thing that's been weighing on the valuations.
Right.
On the other hand, if those companies are completely insulated from competition by the actual Amazons and Facebooks and Googles that are allowed to freely compete, then they're just competing in their home market, which is big enough to still make like print money forever, right? Assuming that you buy the continued rise of China. And that's like, another consideration entirely. But if you buy that thesis, then China's going to overtake the United States. It's actually going to be the prime market. And yeah, they will not be able to compete as effectively without their own gigantic siloed databases, right? So the products won't work as well unless they get some sort of dispensation from the government or review from the government to be able to do what they're doing. But it won't matter because they'll all be operating kind of on the same level as far as that goes.
And we're generalizing. Obviously, there's going to be differences across companies. A lot of them
Yeah.
are expanding internationally, and everything you just said doesn't apply outside of
True.
China, because everything they do outside of China is free market economics. Alibaba has Lazada in Southeast Asia, and that's been losing ground to pretty much every other company in Southeast Asia in the last, call it, 5 years, right? Sea Limited, which we all know for Garena as a gaming company, but they have Shopee, which is the leading e-commerce company in the region. Gojek and Tokopedia just merged down there. So that's just one example. But, there's obviously, once they start going outside of China, there's no more guardrails, there's no more protections. And, that's also something to consider as well.
That's an excellent point, actually. I didn't think about that. Yeah, because like they're going to lose that expertise is basically what you're saying. And as we know, it takes a ton of expertise to figure out what to do with big data, right? It's not just having it. You actually have to leverage it effectively in a product sense. And that requires the right people and a lot of practice. And if those muscles get flabby because you're no longer targeting, right? Because you can't do that within the Chinese market anymore, and that's your profit center. Yeah, maybe you're not going to be able to grow as effectively. So that actually makes a lot of sense.
I think the main takeaway I have from this is that when China sets itself upon an objective, like the government, it'll just, it doesn't care. Like if it wants to disappear Jack Ma for 3 months, boom, he's gone, right? I mean, They literally do not care. I mean, shutting down the, Ant Financial IPO. I mean, they will just do whatever it takes to achieve their objectives.
Yes.
And I actually think that, this is going a little bit off topic and we don't have to talk about it, but I would just say from a Bitcoin perspective, I'd be careful. Like it's not going to work in China.
Well, no, I mean, like they've kicked out the mining, right?
Yeah.
And that accounted for 60 to 70% of global hash power. On the other hand, you've seen the network respond pretty seamlessly, and price is holding up for the time being.
Right.
So
Now, but given all of that risk, we know that some of the world's greatest investors, like Ray Dalio, like Charlie Munger, have been investing in China. Alibaba,
like Macro 108.
Yeah, Alibaba in particular. And I think the thesis behind that is just with, what we're seeing in the US and, there's people on different sides of the fence here, but, I believe in inflation. I believe in dollar devaluation. And if you believe in that, then like you have to be investing abroad, and China is the biggest and most favorable market from my perspective. So just kind of wanting to hear how you guys are thinking about it as far as if you believe in that sort of thesis, given these recent risks, do you believe that China is still investable? Are you guys holding back? Or to your point, Steve, are you thinking where are you winding up on your evaluation here? Are you going to back off of investing in China or double down?
I mean, it's a great question, right? And it kind of gets to the core geopolitical, I guess, schism or reality that appears to be emerging, which is that it may not be possible forever as an individual investor on one side or the other to continue to invest in both sides. It seems like both sides are making moves to make it more and more difficult to do that. As part of what Niall Ferguson has called Cold War II, Electric Boogaloo. He hasn't actually called it that, but and I think actions on both sides have made it pretty clear that there's some kind of decoupling or unraveling happening. It's not a hard decoupling because I think it would take like a shooting war for something like that to happen. But over the course of years and decades, we're seeing a clear trend towards unwinding the, I guess you could call it, symbiosis that emerged after China joined the World Trade Organization in 2001. And the economies of the United States and China became really intertwined in terms of manufacturing base being over there, capital markets being over here, technology flowing mostly one way to China. And then they eventually achieve not parity, although in some areas they're at parity or beyond in certain advanced technologies, especially. you hit the Great Recession in the United States, and all of a sudden, China, is wondering about whether they want to continue this relationship. Xi Jinping steps up to the plate in 2012 and 2013. He takes over the government. He is, the Chinese Communist Party is a nationalist party fundamentally, but he exemplifies that to the nth degree, right? He is not interested in relying on the United States forever for expertise and capital.
That's the whole concept of dual circulation that he introduced, which is new in the last couple of years. I mean, it took him 5 years to really consolidate his power and get his people in place. But, that's exactly what they've been talking about is, kind of internal focus first and then think about abroad as well. But we want to be internally China focused first.
That's right. And they have still hundreds of millions of people in the hinterlands, the interior of the country, that need to be lifted out of poverty. I don't know how well they're doing at that, to be honest with you. I think there's some pretty alarming sort of macroeconomic data or suggestive data coming out of China, that suggests that their growth trajectory is not looking so good, especially, as COVID kind of winds down. It remains to be seen whether the Chinese will ultimately be blamed for COVID in a meaningful sense, and how that will affect things geopolitically as well. So that's another variable that's kind of in the wind. And so I think there is a sense from Xi Jinping, who is in absolute control of the Chinese Communist Party and therefore China, that they need to batten down the hatches and get ready for a storm, right? A geopolitical storm. He is dead serious about reuniting China with Taiwan. And that is, I think, that has extremely serious geopolitical implications, not necessarily this decade, but before too long, right? It remains to be seen how the United States or the Taiwanese might react as well. I don't think we're headed for a shooting war anytime in the next 5 years, but within the next decade, it becomes more and more possible as the Chinese become more and more militarily capable, especially in that theater, right? So,
I would say on the aspect of the valuations and on the aspect of the decoupling, like when you just think about Chinese stocks overall, there's this regulatory overhang that we just discussed. If you think these stocks are whatever, everyone likes to call them compounders, right? If you think these are compounders longer term, if you think that in 5-10 years, whatever, they can double, triple, whatever, if you miss the first 10%, the day that everything gets settled and the dust is cleared and the regulatory overhang is finally lifted, that's not so bad versus trying to buy the dip and call the bottom and potentially losing 20% more, potentially losing 30% more, because no one knows where the bottom is at this point, just as much as no one knows when the overhang is going to get lifted, when the new rules are going to be fully explained, fully implemented, and there's clarity on what the businesses look like long term. So from a valuation perspective, from what you I wouldn't be jumping in and trying to call the bottom today. I'd be waiting for clarity. And yeah, if I miss the first 10%, that's not so bad. I'd rather do that than lose 20%, 30% in the near term. That's a lot worse for your portfolio. And so that's kind of how I think about it. On the decoupling, prior to COVID, we were already seeing it happening on the hardware side. I mean, it's already happened on the internet, right? The internet's already decoupled. You already have two separate internets. Yeah. But on the hardware side, you already started to see the entire hardware supply chain. It's not like you're going to lift and shift out of China. Like, Shenzhou, which is in Henan province, like in kind of north central China, that's literally called iPhone City. That's where like 70% of the iPhones in the world are still assembled, by Foxconn, by Hanhai, which is a Taiwanese company, right? You can't just lift and shift that out of Shenzhou. That's going to stay there. But what you can do is you can build adjacent capacity elsewhere, in India, in Taiwan itself, but Taiwan's only so big. You can do it in Southeast Asia, Malaysia, Philippines, Vietnam, other countries. And you can slowly build diversification. Even Latin America, Mexico and Brazil are getting a lot of investment from these companies now. And then over time, you have a more geographically diverse manufacturing footprint for the hardware side. And we were going that way until COVID. COVID threw a wrench in that because it slowed down a lot of these investments. But I think as we come out of the pandemic, you're going to see more and more of this diversification of the footprint. You're seeing TSMC talking about building factories in the US and building factories in Europe, and Intel as well. This is the norm. This is going to continue. The incremental investment is going to shift away from China and shift towards a more geographically diverse footprint, because you still need to be in China to serve the China market. Look, China is the second largest iPhone market in the world after the US, so they still need to sell a buttload of iPhones in China. But then, when you're thinking about other markets, you can manufacture closer to home potentially, and that's where we're going.
Yeah. So it sounds like, Matthew, what you're saying is for investing in Chinese companies, you would, for your perspective is wait and see, and despite the relatively attractive valuations, especially relative to US companies, that maybe, wait for the regulatory stuff to kind of work itself out. And then Steve, in terms of buy or sell China now, what are you thinking?
I still don't know. Like, part of the reason to do this episode is to try to figure it out. Like, what am I going to do tomorrow? Do I sell half? Do I sell all of it? Do I sell none of it? Do I buy more? I think I'm leaning towards hang out. I bought Baba maybe 2 months ago.
Okay, so actually that's not bad.
Yeah, on the heels of the what was it, $3 billion fine for anti-competitive practices.
Yeah.
And it's interesting to note that a lot of sort of this activity may look like it is politically motivated, and perhaps it is. But like the Chinese Communist Party is accomplishing at a stroke what our own regulatory authorities would really like to do in some cases to your Amazons and your Facebooks, and have proven completely incapable of doing through our mechanisms of governance. Right. So you can look at our homegrown monopolists, right? And depending, like, I'm invested in some of them, right? Particularly Amazon, right? And you can say, well, these guys have way too much power. They've actually achieved escape velocity, and there's going to be no way for the United States to come together and actually break them up. Perhaps China, has actually gotten ahead of that, to a certain extent. And that could be a worthy goal just from a governance perspective. Again, depending on what you think about what these companies are actually doing and the implications for governance in the United States or China, respectively. But to me, valuations are going down. I don't think that any of the fundamentals of the business have changed in a meaningful sense within China. I think your point earlier, Matthew, about competing outside of China is a really good one. If they lose the capacity to leverage their data, that's going to be really bad in Southeast Asia or India or any place else, right? But again, the Chinese market is massive, and as far as I'm concerned, I need exposure to the Chinese market. I'm not sure how else to get it.
Yeah,
that's
right.
Alibaba, and I think Alibaba is too big to be extirpated by Xi Jinping. Even I don't think he wants to do that. I don't think there's a reason to do that. Right. He shut down Jack Ma, right? Baba remains. Right. So I think I'm going to stick with it and kind of watch that delisting possibility carefully. But my understanding is, just given the way the laws work, the new disclosure laws from our end, from the United States' regulatory, apparatus, they're going to require disclosures, more data disclosures, more governance disclosures from foreign corporations that are trading in the United States. And that is the part of this that is kind of in direct opposition or contravention between the two sides. The Chinese do not want to give the United States that data. The United States wants that data from the Chinese. And that's kind of the inflection point where you might get a delisting and lose your investment completely. potentially. But I think there will be more signs of that happening before it actually happens. So I'll have a chance to exit. Until then, I think I'm going to sit tight and wait.
Yeah, I mean, I think the way I think about it is that the relative risk of this regulatory action, because for me, everything makes sense so far. The actions against Alibaba, Jack Ma, the actions against DIDI, they all make sense. So the relative risk versus massive inflation in the US, dollar devaluation, just shit going wrong in the US is just so much higher that I think that, in my personal opinion, I feel like people must have some exposure to China or, outside of the US. Now, how much, I don't know, but, for me, it's quite a bit. It's about a quarter.
That's a lot.
For me. Yeah.
I
Alibaba
would
hit me
also
hard.
add, sorry, I would also add that China has all of these legacy industrial businesses that are mostly state-owned companies that are extremely highly leveraged, like iron ore smelters and, things that they don't want to be doing anymore. And in the past, they've always talked about deleveraging, winding down these businesses. And every time they try to, GDP growth slows, they throw it away and they kick up the leverage again and juice growth again.
Right.
The biggest question mark is still, they need these tech companies to drive growth as they deleverage these legacy industries.
Right.
So they can't just kill them. They're not going to go away. To Steve's point, Alibaba needs to exist. It's too important to the economy overall and to everything they're trying to do. But what's the cadence to which they're willing to wind down all of the legacy infrastructure in the country and let these companies, just go gangbusters on growth? And kind of what's the speed limit on both? If we're on a highway, what's the minimum speed limit for these legacy businesses to coast at, and what's the speed limit on the high end for these new businesses? Because it was the Autobahn before. There was no speed limit. Alibaba could go 200 miles an hour, and there was no rules and restrictions on what they could do. There's clearly now a speed limit. We just don't know what it is yet.
Yeah. And I guess one other thing I could add is just having worked in Beijing for almost a year, and not that I got exposed to the inner workings of Chinese government, but from what I heard, it seemed like a lot of the high tech leadership were pretty chummy with those guys. It's kind of like
you have to be.
Like they were kind of. It seemed like there was a pretty good relationship. So it felt like it takes something pretty dramatic for them to do something, right?
Yeah,
And
the fact of the matter is like the Chinese Communist Party extends its tentacles into the management of a lot of these huge corporations, right?
Yeah, and
even the high tech ones.
right.
So, and that's by design, and it's by design both directions, from the direction of the party and from the direction of the corporation, right? Because you need that buy-in from the authorities in order to get anything done. Like that's just how business gets done in China. It's my understanding. Not that I've ever done business in China, but from everything I've read and from people like you, Macro, what you just said, it makes perfect sense, right? So it's not like it's a mystery what's going on, right? Like, yeah, Xi Jinping has acted arbitrarily and some would say capriciously in a lot of areas of his purview, which now extends everywhere forever, right? But on the other hand, like these guys have to know some of what's happening, right? And yeah, it's like there is a regulatory framework. They do have, I guess, not the rule of law necessarily, because it can change arbitrarily and without much public input. But it's not like things happen randomly, right? So I would imagine that these companies are going to devote a lot more attention to what's going on with the party and with Xi Jinping and what he wants them to do, and not grow as effectively, not be subject to competition, and just hang out in the home market and like do pretty well. One question I have is if it's possible to gain exposure to the Chinese market and Chinese growth and currency hedging and all of that by investing in companies that sell into the Chinese market, instead of companies that actually are indigenous to that market. What do you guys think?
I mean, that's always been one way to play it, right? I mean, but you also talk about the risk there. Joe, you mentioned the risk with Tesla.
Yep.
That's a great example. Tesla was the first automaker to be allowed to fully own its China operations. GM has a joint venture there, right? So there's tons of ways to play the market for companies that have exposure there. Apple, Ericsson on the 5G infrastructure, but these companies are always kind of playing second fiddle to domestic champions in lots of different ways, right? Ericsson is second fiddle to Huawei domestically on the 5G infrastructure. Apple is kind of second fiddle to the Android domestic phone makers like Xiaomi and Oppo and Vivo, right? And so I think you get some exposure that way, but then also you have to consider these companies. What are you actually buying? Because, Apple gets 20% or so of its revenue from China. So it's not directly exposure to China. It's only partial. And how much of that is actually being reflected in your portfolio? So it's not going to be as effective of a way
Yeah.
to invest in the country. It might give you protections from the risks around the VIE structure and things like that, but you're not going to get as direct exposure as I think you'd want by going that route.
Right. It's pretty diluted and indirect. And yeah, like I'm long Apple, and I've been long Apple for a long time. And I don't even think about what they're doing in the Chinese market. But it's always like, well, what's the new thing that's happening here? Right.
And
Where's that
Matthew, what about
self-driving car?
Sorry, what about other Chinese names in terms of, I know Alibaba because I just watch what like Ray Dalio, Charlie Munger kind of invest in, but as far as other companies, whether it's Pinduoduo or I don't know if you have thoughts on DIDI or other Chinese companies, if there are folks in the audience who want to invest in China, what are you covering, or what do you think are other names to consider?
We're also looking at some of the cloud and AI software companies that are, well, there was going to be 4 IPOs in that space probably in the second half of the year, and they all are just getting kicked, I think. So there's kind of like 4 AI champions that are private: Megvii, SenseTime, and a couple others. And Yi2 is the one that just pulled its IPO filing on the mainland. iFlyTech is listed already on the mainland, so that's one to watch. They're an AI software leader. There's a company called GDS Holdings, which is listed in the US. They're a data center operator. So, cloud AI software is becoming a huge target investment area for the Chinese government.
Yeah.
And these are the companies that are going to benefit the most. Obviously, Tencent and Alibaba as well, because they're the leading cloud infrastructure players. It's just when you're, as a percentage of Alibaba and Tencent, cloud is still a rounding error. It's not, even, and Tencent Cloud's biggest customer is Tencent, right? So it's, and that's great. That's how Amazon built AWS, but they're still a long way from becoming the drivers of the business. Like, AWS is a key driver of Amazon now. It's still a long way from these businesses getting to that scale yet, I think, but when you think about, just kind of that sector's growth domestically, I think that's something we're watching. And then obviously, there's just the traditional, the companies you all mentioned, the e-commerce ones. The e-commerce sector is interesting because this community group buying business that really took off in the second half of 2020. If you don't know what that is, it was basically a way to get e-commerce into the more rural areas and to older people, particularly for grocery delivery when all the grocery stores were shut during COVID. So what it does is you have a community leader, usually it's like someone that owns a little shop in your little neighborhood, and they download an app from any of these platforms, and they basically bulk buy for everyone in the neighborhood, and they're responsible for delivering the goods to the people in the neighborhood, up to 50 people per community buyer. And that's been a huge investment business. Tons of money has poured into that in the last, call it, 12 months. DIDI was in it, Tencent's in it, everyone's in it. And it's just a race to zero right now in terms of marketing user acquisition dollars. And I don't know if that business ever makes money, because there's so much VC money pouring into it that you're just gonna have companies keep coming and throwing money at user acquisition that I don't know if the incumbents can ever make money. And if do they want to just keep burning money doing it? That's something that we're also watching. And so I'll be curious to see if, as things normalize and as people go back to buying groceries actually in stores, if that business starts to become less competitive and less intense and can actually make money. It's clear from a lot of the companies, even in the first quarter of this year, they were still pouring buttloads of money into it. So it's by no means near an inflection point there. That's something to watch in China as well. And that's going to continue to weigh on all the e-commerce names that you mentioned. They're all involved in it.
Okay. Yeah, and that connects to like this idea of like the hundreds of millions of Chinese in the hinterlands, right? That aren't really fully participating in either the export economy or the domestic economy, right? That's an untapped market, and like they have some purchasing power, but they need to develop that, right, in order to really be able to get away from American money. It seems to me. So maybe this is a step on the road to being able to do that.
I mean, at the end of the day, the logistics is what will win, right?
Yeah.
So Alibaba and JD have the best logistics networks on the e-commerce side. So theoretically, they would win, anything e-commerce related. It's just as long as companies are willing to literally like buckets of money on fire to sign up users for free, like who knows when things normalize before we get there. And if the large companies just say, this cash burn rate is not worth it. You already saw DIDI. They have this business. If you look at their filings on March 31st, so right before the second quarter started, they did a transaction with SoftBank, who's a big investor in DIDI, where they sold minority interest in this CGB business. So they deconsolidated. So it's off their books now. So if you look at their cash burn, their negative EBITDA, and their other businesses, it was a straight line down for the last, call it 9 for the last 3 quarters because of that business in particular. But now it's going to be off their books. It won't hit their P&L anymore in the second quarter and going forwards. So not to say they're giving up on it, but they're definitely, getting it out of their core business. It's now a minority interest. It's no longer a consolidated subsidiary. So I'm curious if others will follow suit and do something similar to that, just because it's a money pit. It hasn't been good.
All right. Well, I thought maybe like one last question I have from my side is just when we think about, and we kind of talked about restrictions in the Chinese domestic market when, for example, we as app developers try to launch a game or app in China, we have to work with a local partner. We know that Facebook and Google are banned in China, and there hasn't been as much reciprocal kind of regulation on the US side for Chinese companies trying to come into the US. That started to happen under Trump, but I think now that Trump is no longer in power, and because I guess there were specific things that I think upset him, right? with respect to like how TikTok was used against him and things like that. But like all of that aside, what do you guys think are the chances of this increasing move towards an increased splinternet or the splintering of markets? What do you guys think about that? Do you think there will be reciprocation in the US, and how does that play out from a markets perspective?
I don't think that US regulators care about games enough. And like, that's not to say that games aren't
Sure.
important,
I
because
mean
I
more
love them.
broadly.
But like, yeah, like, and people always ask, like, even 12 months ago when TikTok was going through what it was
Right.
going through, is Tencent going to have to sell its games business? It's like, probably not, because they probably don't, most people don't even know that Riot's owned by Tencent. They just know League of Legends and Riot Games.
Yeah.
They didn't know
Yeah.
that it's controlled by Tencent. So I don't think the average person cares about that. I think I agree. I think there will be more restrictions on data sovereignty, data privacy, and we've already seen that. Europe's been further ahead in that than the U.S. has. I think the U.S. will start to narrow that gap at some point. They just have a lot of legislation on their agenda to get to ahead of that. But those types of things are huge in the world right now, and the U.S. has to catch up for sure on some of those regulations.
Yeah, I think the urgency is not there the way that it needs to be. And typically, what happens is this is going to sound bad, but I think it's true. It's like you kind of need to lose a war to understand the power of whatever commodity it is that you're neglecting. Um, and like again, I don't necessarily think this is going to happen anytime too soon, right? But in some future war between the United States and China, should that come to pass, if the Chinese events superior understanding and ability to leverage AI for instance, and does better in that conflict than they otherwise would have, the United States will get really serious about data sovereignty and stuff like that. I think right now there's still, frankly, the free market wins out here, right? Free speech wins out, and there's no sense necessarily that the government owns everybody's data or even individuals own their own data, right? There are some undercurrents, especially on the state level, of kind of moving in that direction, but it's chaotic, right? It's very difficult to impose that type of framework on a federal level, barring some kind of national security emergency. And I think that Trump tried to play that card, and people just kind of didn't believe it. Like, TikTok, what? It's like, on the other hand, you think about how TikTok operates, they generate 500% more data on a, I guess, daily active user basis than YouTube, simply because you're exposed to so many more videos and therefore generate so many more data points, right? And that's really the name of the game. It's data density.
Right. Well, I think it was even more than that, though, because I don't know how real this was, but I think it was like the New York Times or Wall Street Journal had reported that there was like, I don't know if it was proven, but that TikTok might be like reading from WordPad or the Notepad and taking that and sending it back, like reading from other apps.
Like, even if all it is doing is measuring user behavior within TikTok, it's like, I would be hard pressed to design an application that would be better at back engineering, like the psychology of American teenagers, right? And think about like the meteoric trajectory of their growth, right? They've been very successful at it. And I'm not suggesting anything sinister, but if I'm, I work for the government, I'm looking at that, it's like, that's kind of a risk. If I'm with the NSA or the CIA or whatever, Defense Intelligence Agency, that's something that I would probably be taking seriously. And again, because it was Trump, half the country was like, oh yeah, this is really bad. The other half of the country was like, this is nonsense. Like, you don't even know what you're talking about. You're just doing this for, political advantage or whatever. Nothing got done. Right?
Yeah, I think the other risk that people mentioned with respect to TikTok was that if they were able to get user data on young kids now, let's say there's somebody who's 16 now, and they can tell that they are maybe not heterosexual. Maybe they can tell about certain things based upon TikTok behavior. And then once they become a politician in 10 to 15 years, and Chinese play the long game. And then they're like, aha, we know.
Or you could do something
about you.
even more diabolical, which is, once you have that, small group model of behavior, or even the individual model of behavior, if you've watched tens of thousands of these videos, they can start programming you by showing you other videos and figure out what you're going to do behaviorally, right? At least within the confines of the app.
That's what Stalin did. I mean, not with videos, but with print.
Yeah, propaganda, right? Yeah. So, and to whatever extent you think the Chinese Communist Party is a Stalinist party, and it certainly has Stalinist characteristics, especially under Xi Jinping. Yeah, you combine that sort of focus and ruthlessness and, I guess, purity of power with that scope of data and technology, and that becomes a pretty scary proposition. But again, I don't think the United States is in a position where it's able to do anything about it right now. I think it really does take a legitimate national security crisis before we act. And look what happened during like COVID, right? That was a legitimate national security crisis, and it wasn't recognized as such, right? At least in some segments of the population. So it's like, yeah, you say what you will about the Chinese Communist Party. It's like, as you said earlier, Joe, it's like, once they decide to do something, it gets done immediately. That's both good and bad, of course. Right. So I would be less worried about that to close the loop.
All right, guys. Well, I think that, do you guys have any final messages? I think that's just about it from my side in terms of questions and discussion points, but I don't know if you guys have anything else left to talk about. I'm still bullish. on China.
Bloomberg Terminal subscribers can read all of our research on Chinese internet and e-commerce, as well as all of our global tech coverage on BI Go on your Bloomberg Terminal.
Nice.
Yo, can we get some promo codes or something for that? You guys give those out?
This isn't in game alpha. There's no alpha codes to give.
Too bad. Yeah, no, I'm holding Baba. I'm not getting more, but stick with it. See how it goes.
All right, cool. All right, guys, thanks so much for your time. And for everyone else, catch y'all next time. Bye.
Thank you.